Now, I'm actually going to use a case study here example. And by the end of this case study, I'm going to show you how we improve this person's situation, not only for the tax that they're paying, not only for the savings that they're going to make, but also for paying off their home loan faster. Is everyone okay with that? So we're going to take John, his typical situation here. He's got a yearly income of $120,000, so I had to make some assumptions, and I'll explain to you why I've done that as well. He pays $32,000 a year in tax. Tax freedom day is April 7th, so 97 days or 26.5% of the year has already passed for John by the time he meets that ATO obligation. For his home loan, 25% of his income, as per Australian Bureau of Statistics data, so $30,000 a year goes to his mortgage. So John reaches mortgage freedom day and tax freedom day together on July 7th. So 189 days of the year, or 51.78%, has now passed for John. John now has $58,000 left to earn for the rest of his year. And these are things, as I said, utility, electricity, gas, rates, groceries, travel, insurance, childcare, school fees, more. I mean, who here has children? Aren't they amazing? Their little feet can crush all of your big dreams. So the whole thing about that is that at the end of the day, there are so many more fees that come into account. See, I see so many parents nodding. So many fees that come into account that I'm not even going to talk about today. But you, as everyday people living your lives, already know what these costs are. So when it comes to savings, John will have very little. And according to a recent study by Suncorp, the average Australian saves about 427, let's say $5,000 a year. That's the average savings that the Australian family has. So the main things for John is he wants to grow his wealth. He wants to minimise the tax that he's paying every year, bring tax freedom day earlier. And he wants to pay off his home loan faster. So we need to look at some numbers here. So first of all, Australian dwellings have grown on average by about 6.4% per year, as the chart will show you in your documents that you have in front of you. And that's over the last 25 years. So the capital gains over the last 25 years equates to an annual growth rate of around 6.8% for houses and around 5.9% for units, which is always a good average to look at when you're personally looking to purchase an investment. Is it above that average? Is it below that average? What catalysts are going to move that property for me that I can identify with a certain degree of certainty? Now let's buy a very carefully selected property. We do not have time today to explain to you our three-tiered research methodology. Again, if you do want to come to that other event where we go through the property cycle, we will go through that in more detail. But today, let's just stick to the strategy. Let's assume we've done our job that we've been doing for 13 years. We did it right. What's the result of that? So we purchased a carefully chosen median price property, and the median dwelling price for combined capitals is around $602,000 at the moment. I'm going to use a case study that we did recently. It was $610,495, but to make it a bit simpler, I'll just say it's 610 grand. You can see it's up there. So by utilising the equity in his home, John's able to purchase a $610,000 investment property without the need of a cash deposit. So his cash flow still stays basically the same. After crunching all the numbers, we've actually found that the holding cost for the property is going to be, after tax, about $31 a week. So now he's got that in his budget. We've worked that out by the cash flow, all right? Every client that purchases a property should automatically do their numbers. With Providence, you're unable to buy a property unless we do the numbers for you. The tax credits received, which are in this column here, average, after combining them all and looking at the average there, they average about $5,703.50 per year, which is a discount to John's tax freedom day of around 17.8%, or 16 and a half days. So now 16 and a half days earlier per year by purchasing this property. So the property is actually also accumulating wealth, and based on 20 years historical performance, the average yearly increase in wealth for John in regards to equity is $44,853. It's not hard to imagine too, because I just showed you that the average was around 6.4%. I've actually averaged this down to 6.1%. So I've made it a little bit more conservative. So here are now John's numbers, side by side, just so you can get a little bit more of an understanding for the comparison. He now pays $5,703.50 less in tax per year. He reaches tax freedom day 17 days earlier, and he starts earning money for himself on the 21st of March. The biggest change, though, for John overall, for his financial future, is now his savings plan, because now he's creating wealth, and that wealth is passive, and it's sitting there in the background for him. And he's basically increased what Suncorp said would be his $5,000 savings by almost 800%, which is going to change things for him significantly as he gets older. But these are only 2 out of the 3 things. He also wants to pay off his home loan faster. So now what we're going to do is have a quick look at mortgage freedom day, how we can change that as well, because we need to tip the scales on everything. Every client's going to have different requirements. You might not want all 3 of these. You might only want 1 or 2 of them. But this is just an example trying to incorporate all of them. So John has $600K owing on his home with principal and interest repayments. I modelled this on 4%. I'm not sure if you talk with Natalie and her team and they crunch your numbers and look at your circumstances. They can either do better or they can get you a better product that's going to allow you to do better at the end of the day. So make sure you speak to Natalie because they're fantastic. And all of our clients that have used them have been really happy. So continuing with this, principal and interest repayments, roughly $30,000 a year based on the average details from the ABS that I gave you. So that's around $2,000 in interest and about $1,000 in principal. In 10 years' time, he would have reduced his home loan by $125K. So that's the debt for the principal that's gone now. At this rate, it's going to take him 30 years to pay off his home loan. But when we add an investment property to the exact same scenario there, so we're still in a position where John owes $600K, he's paying $30,000 a year, same position. But this time, as I said, John uses equity in his home to purchase an investment property that we spoke about earlier. So I took all the numbers from the initial cash flow report for you. Like before, in 10 years' time, John would have reduced his debt by $125K. But at that same 10-year period, he's got this investment property and it's working for him. And during that time, and taking all selling costs into account, because actually, if you are good at maths and did the numbers in your head, this is well over $400,000, but we're going to take capital gains tax. The holding cost for this property, by the way, over this period of time, was just shy of $13,000 out of pocket after tax, when I took all of the calculations into account. So based upon this, he's made $300,000 profit. That shaves around 63% off that loan, which is the equivalent to 14.5 years of repayments. So John is now able to pay off his home based on that strategy from that point that we originally started, 15.5 years. So I've just showed you tax, savings, paying off your home loan. I'm sure some of you have already done this, you've already participated in the strategy, but it is very interesting to actually look at it on paper and how it works. And hopefully the assumptions I've used are very conservative, so you might have done better than John.